Hi, good afternoon, everybody, and welcome to our event, Nature's Role in the Economy, Assessing Natural Capital. My name is Zara. I'm from WWF Malaysia, and I will be your MC for today. This event is a second of a collaboration between Capital Markets Malaysia and WWF Malaysia to introduce and familiarize the concept of natural capital to Malaysian businesses. We strongly believe that businesses both impact and depend on natural capital, and that you will benefit from knowing how. Additionally, globally, we are seeing a big move to reporting on natural capital, just as we saw with climate change. This is something we'll explore more of today with Hitesh Kataria from KPMG Assurance and Consulting Services and Sharat Martin from ACCA. I will start us off with a short recap on natural capital and what we looked at during our last session. I'll then be followed by Hitesh and Sharat, and we will finish with a Q&A session with Luan Cie of CIMB as our moderator. The webinar will last for 1 hour, and if you have any questions, please do enter them into our Q&A box on the bottom of the screen. So without further ado, let me bring my slides up. So this is the poster for our last session, and I'm just going to recap some of the things that we learned there. So we started off with Isabel Hoffman from the Capitals Coalition, and she introduced natural capital to us by comparing it to other capitals that we are familiar with, and also giving an introduction to capitals in general. So the idea of capital is that is any stock or flow of energy and material that produces goods and services. Financial capital is a representation of natural, human, social, or produced capital. And let's dive into natural capital. So natural capital is the basis not only of production, but of life itself. And it is made out of stock and flows. The stock is biodiversity and ecosystem services, biodiversity and ecosystems, and the flows are ecosystem services. So things like water regulation, carbon storage, medicines, food, climate regulation, and inspiration are all produced by natural capital. This is a wonderful depiction of what we normally think of as what nature contributes to our economy versus what we do actually get from nature. So on the left is what we get from wood, which is timber, wood, fuel, and employment. And on the right is what we actually get from trees or the forests. So you see all these different ecosystem services here, which are being produced by nature and do contribute to our well-being and our economy. And we can also actually put a value on that. So on the left here, this is a depiction of a case study that was done in Thailand showing that for every hectare of wood of a mangrove forest in Thailand, you get about $1,000 US. But if it was kept as a mangrove forest, then actually you're looking at $21,000 US for flood protection, carbon capture, and as a breeding ground for fish. So moving on to what we also learned from our session, from our last session, our speakers really kind of showed the environmental imperative of valuing nature and taking care of it. We saw that 44 trillion US dollars of economic value generation is actually based on nature. And Michael Savatico of S&P Global also showed that we are rapidly running out of the natural ecosystems that we depend on, and it's something that we really should be taking care of. Isabel Hoffman talked about how the challenges that we're failing to address the global challenges of nature loss, climate change, and rising inequality, but the solution is that we start including the value of capitals in the decision-making of business, financial institutions, and government and this would deliver a fairer, just, and more sustainable world. We looked at how we all impact and depend on nature, but it might not often be visible in our decisions, which could mean that we're mismanaging our assets. So if the impacts and dependencies on nature and people are understood and acted on, then there are significant opportunities. Isabel talked about, gave an example about how we can impact on the capitals. So one example which was given was if an organization uses water, then there might be reduced water availability in the region. And then this might also then impact and introduce operational, regulatory, and reputational risk. Sorry, I think I might have lost my slides. Sorry about this. Let me try that again. Nope. Okay. Very sorry about this. So we also talked about dependencies on nature, and Isabel talked about how if an organization is aware of the dependence on, for example, a limited material, then they can choose to invest in R&D for alternatives. And this will also review opportunities to reduce risk and increase reputation. We also heard from the speakers about natural capital assessments that companies such as Puma and Kering have done, which showed that which showed that 150 million euros of their impact, it showed that there was 150 million euros of impact on natural capital from Puma, with a majority of it coming from their production. Kering also saw that the majority of their impact on nature also came from production, and it was on land use. Another interesting thing that we saw from Michael Sabbatico was that climate change will also be a significant impact on natural capital. So we need to be aware of how our organizations depend on natural capital, and start assessing the risks that will arise from climate change. Okay, so sorry about that. Of course, there was a lot more from our last session. So if you weren't able to join us, please do have a look back at the recording, which is available on the Capital Markets website. Now, let me introduce our first expert speaker, Hitesh Kataria of KPMG Assurance and Consulting Services. Hitesh has 12 plus years of experience in business sustainability and is currently leading ESG projects for KPMG. He previously worked with the Mahindra Group in sustainability and strategy and has led projects in carbon pricing, ESG disclosures, net zero, carbon offsets, EVs, climate advocacy, and biodiversity and natural capital valuation. Hitesh has been voicing the role of the private sector in solving economic, environmental, and social challenges intensified by climate change. He graduated in economics and postgraduated from the School of Inspired Leadership, a B school with an emphasis on leadership. He was awarded a diploma from the Swedish Institute Management Program Asia in 2020. He enjoys trekking and his time spent in nature. Okay, please take it away, Hitesh.
Thank you, Zara. Very good evening, good morning, good afternoon to wherever you are, in whichever part of the world. Thank you for this opportunity, WWF. I have few slides which I would like to share with you and talk about the subject of assessing natural capital. So I think we can start with that, Zara. Is that correct?
Yes, please.
Okay. I hope you all can see my screen.
Yep, good to go, Hitesh.
Thank you so much. Okay, so many of you have heard about this term assessing natural capital. Many of you are using it in your businesses and using it as a tool to, assess natural capital. Now, what are we going to talk about uh, in the time which is given to me? Let me just quickly talk about it. Why natural capital valuation? Overview of international standards. What's the history of valuation? Right? Why natural capital valuation is important for Malaysia. And I belong to KPMG. I representing KPMG India office. So hence I would be talking about KPMG True Value Framework. So the base is what? You can't manage what you don't measure. I think that is something which is very clear to all of us. Availability of natural resources are finite. Collapse of biosphere systems that in turn would cripple planet's ecosystem, people, and markets. I think there is no doubt about these statements. And with a heavy heart, we all accept it. Now, what we can see is, natural capital valuation, there is a funding gap. If we look at some of the reports which are available to us, we can see that we are spending somewhere around close to $100 billion. Uh, every year, 2019-20, these are the estimates on biodiversity conservation. But if we look at the amount we need to spend globally, this is somewhere around 722 or 967 billion dollars. There is a huge gap. And why it is important to first accept there is a gap, because unless and until, as I said, we are measuring the financial numbers, the financial impact, to the extent what kind of money do we need to solve global problems, we won't be able to take actions. There are, of course, overview of, there are standards, international standards, and which have been guiding how to guide investments, how to measure investments. So let me just give you an example. So in 2011, when SASP came up, at that time, the entire concept of natural capital valuation was pretty new. And I'll come to that. But there were a few companies which were which started their journey on natural capital valuation. When TCFD came in, again there was some resistance from the organization that how it is going to be helpful for me. Is it only for banks who are lending it? So this framework then was adopted by some organizations, but it took time. In 2018, when Natural Capital Coalition was formed again, the concept of natural capital valuation was trying to find its feet. In 2020 World Economic Forum, they gave more clarity when they created stakeholder capitalism metrics, and they talked about how the materiality from GRI, CDSP, TCFD, SASP, and NCP can merge together. And this was designed around the four pillars, which were principle on governance, principle of planet, people, and prosperity. Finally, we have something called TNFD, right? And my colleagues will get deeper into the subject of TNFD. What is it and why it is impacting businesses? But Task Force on Nature-related Financial Disclosures is aiming to bridge that gap, that we can start to measure, the funding requirements. This is a snapshot of how the industry globally has, moved on natural capital valuation. Of course, we have taken some early steps. All of us have seen what Puma has done in 2010 on environmental P&L. We know that other organizations, so before that, even Michael Porter had published Creating Shared Value, right? Our own company, my own company where I'm working currently, KPMG, they started the first social EPL, for Ambuja Wholesale Company in 2014, using True Price, True Value, which I will talk about in the subsequent slides. In 2019, when I was working for Mahindra Group, at that time we used true cost methodology to identify, what's the invoice from nature. If an organization has to really internalize all the impact it is doing to social and environmental factors, what kind of impact are we talking about? And luckily in 2020, at least for India, I can talk about the Confederation of Indian Industry. They encouraged Indian businesses to do valuation. And it was as part of the CEO commitments that we must do natural capital valuation if we really want to understand what is our impact on the nature. Let's talk about Malaysia. Most of you are in Malaysia at this point of time, and all of us are aware of it. The country's forest cover extends to around 59% of the total land area, right? There are a lot of natural resources your country has, especially, let's say, oil, timber, fish, which is solely dependent on the ecosystem services. If you don't have healthy soils, clean water, pollination happening, you won't have these, services by the nature. Let me just talk about the kind of money which is being lent in Malaysia. And thanks to my colleague, we have done some research on this. So banks are currently lending to real estate activities, construction of buildings, and that's where a lot of money is going in Malaysia. And if you see, 87% of Malaysian bank commercial lending portfolio could be exposed to sectors that are strongly impacted by ecosystem services. And these sectors are, agriculture, fishing, forestry, construction. And hence, I think it's very important for your businesses working in Malaysia who have impacts and dependencies in the country, start accounting the ecosystem services and the kind of benefit your business is driving on it, or the kind of negative impact, let's say, it must have brought to it. But what can we do? I think that's what everybody must be asking, that, okay, as an organization, what should I do? So our suggestion is that, of course, one should start to adopt the national capital accounting practices, right? Establish a task force for nature financial disclosures. It will give you a framework which will help you do the risk assessment, create financial incentives, that can transition to nature smart economy, and also enable financial infrastructure that can help you generate green finance. I'll just give one example of this organization Bunch out of US, which created a sustainability linked loan, right? It's an agri company, and their interest rate was tied to the borrowing company, reducing its biodiversity impact. This is, I think, a very good, a practical example how an organization finds its value in biodiversity, the kind of impact that organization or their lenders can, make on biodiversity, how a loan can be, the interest rate of the loan can be linked to that. So this is one such example. But in terms of when we say what to measure, when we are looking at an organization's, impact, the drivers are but obvious. So it's the greenhouse gases, it's the air pollution, water extraction, water and land pollution, waste generation, land use change. And these are the kind of impacts, it can bring. So if we just take, let's say, underwater extraction, if we have to start measuring what kind of impact we have produced, the outcomes will be, let's say, the fresh water is unavailable going forward. The impact it has is productivity loss from increased malnutrition due to unavailability of water for agriculture. And that's how you actually put a financial number to it. Otherwise, it's very difficult to say, what is my financial impact on water extraction, or what is my financial impact on air pollution? For air pollution, let's take an example. If there is an increase in concentration of air pollutants, particulate matter, NOx, SOx in the air, it can increase in mortality and morbidity from increased incidences of diseases, right? More number of people will fall sick if air pollution, is not as per the prescribed limits. So these are the ways we, put a financial number and tangibles to what we are measuring in the ecosystem. Now, let me just quickly talk about the true value framework. In this, of course, when we started in KPMG on this journey, the framework was designed in such a way that it would identify and quantify the positive and negative externalities to assess the company's true earning. So it is not just looking at the balance sheet, the profit and loss statement, what kind of income I'm earning or the cash flow, but looking at the externalities, looking at my impact and dependencies, what kind of that should help an organization determine its true earning, right? And if we look at what are the drivers of internalization, it can be market dynamics, it can be stakeholder action, or regulation and standards. And in this framework, it's also important to look at the strategic response of the organization, whether the organization is reducing the negative externalities, increasing the positive externalities, and what kind of investments the business is generating to grow revenue and cut costs when they look at these opportunities, right? And then I think it should help you translate your corporate value. What kind of cash flows are now coming? What is the risk associated with my cash flow and the future earnings? And basis that you get a few earning. You get a estimate of a true earning. Now, what is true earning? So by combining financial and monetized externality data, it becomes possible to form a broader view of the company's value creation. So it is not, again, as I was saying, what kind of so your cash flow are dependent on the risks, right, which the business is facing on everyday basis. And as I was giving an example of, if your business is wholly and solely dependent on, let's say, agriculture, right, and because of climate change, if productivity loss is there in agriculture, then it is going to impact your earnings. So I think that's something which we are talking about today, that we must estimate the true earnings. This is one such example. So how this graph looks like. So of course you can see revenue, cost, and earnings, right? But then when an organization starts to do good, it creates an economic positive. When it doesn't do good, it creates an economic negative, right? When it is doing social positive, it creates a plus. When it is doing a social negative, it creates a minus. So like this, towards the end, you create true earning for your organization. What are the plus and what are the minuses? And that's how true earning is, estimated for an organization using the true value methodology. This is one such example which was done in India on a cement company. And that's where this first step was to quantify the economic value add and the social and environmental externalities. The second step was to understand the future earnings, which may be at risk from internalization of externalities. And the step 3 is to identify the strategic initiatives to create a corporate and social value. And this was a step-by-step approach which was taken in this particular cement industry case to really estimate what's the true earning. And this is how the graph looked like. And every rupee which was spent on positive natural capital, generated at least 8.5 times rupee of social environmental value. So when an organization spends on, let's say, renewable energy, when an organization spends on managing its waste and water, it brings, so that's where the true earning of the organization keeps on going up. But when it is producing more harm than it is doing good, then the number of minuses keep on rising, and the earnings which are coming at the end of the day may look positive, but overall, if we look at the environment also under that perspective, then we'll see that the organization hasn't done good. So this is where I wanted to touch upon today. I hope these some of these frameworks and these slides are going to be helpful for you. Thank you so much.
Thanks very much, Hitesh. Now let me introduce our next speaker, Sharat Martin. Sharat is ACCA's Senior Policy Consultant for the ASEAN ANZ region. He works extensively on thought leadership and professional insights on contemporary business issues. Prior to joining ACCA, Sharat held senior risk and strategy related roles. These included with a Big Four firm, a large listed company with global operations, and the Malaysian capital market regulator. Having lived and worked through the Asian financial crisis in 1997, the global financial crisis in 2008 and 9, and now the pandemic and climate-induced crisis, Sharat believes strongly in the need to think long-term in a short-term world. Sharat has a postgraduate diploma in financial strategy from the University of Oxford, Syed Business School, and is a fellow of the Association of Chartered Certified Accountants. He is a father of 2 whose core passions are yoga and cricket. Over to you, Sharat.
Thank you, Zara. A very good afternoon, everyone. And I think having heard Zara, I think it's a reminder that I need to cut down on my profile. But, I think I'm just going to continue on, not just from Hitesh's presentation, but really the overview that that Zara shared at the beginning, which is marking the fact that this series is a continuation, or this event is a continuation of a series. And in the first series, for those of you who attended it, there was, I think, a fair amount of discussion by the Capital Coalition's team around how do you, put a price to the impact that you have on the environment. So with that in mind, today I just wanted to use this opportunity to speak to you about some of the developments that are happening in the world of financial reporting insofar as it relates to nature. And I don't want to spend too much time on context, but I think it's also important just to spend, a little bit on it. So if I just, for some reason, my slides are not moving. Okay. So the first point is, and some of you may have seen this before, but before the pandemic really became a huge deal for all of us, there was a report put out by the World Economic Forum. Unfortunately, I think after COVID hit, we weren't really looking at this. But the point is still valid, which is a lot of our economic value in the world, in fact, more than half of the world's GDP, is either moderately or highly dependent on nature. And you can look at, some of the three largest sectors here, which are highly dependent: construction, agriculture, food and beverage. And if you're from these industries, then, you really need to be taking into consideration how you could be impacted, your dependencies from nature, and how you're impacting nature. And if some of you are struggling with this, entire concept, I would urge you to just look around you. If you're at home or even if you're at office, and look at everything around you and ask yourself, what of the products and the items that you see do not in some way come from nature in the very beginning. Now, apart from these three industries, there are these other industries which, from a direct impact perspective, isn't quite significant. But if you start to look at the impact on their supply chain, you then realize that the consequences that we're going to face from any risk to nature is going to be far beyond just those three. Let's just take a few examples. If you're in the supply chain and transport industry, if you're in chemicals, aviation, tourism, real estate, mining, and even retail and fast-moving consumer goods, your supply chain is either highly or moderately dependent on nature. And this is really important to recognize because, firstly, we're talking about supply chain. And I think in time, the conversation is going to move from supply chain, which is your customers and your suppliers, to value chain, which is not just your customers, but your customer's customer, not just your suppliers, but your supplier's suppliers. And then you add in your community, you add in the government, you add in the investors. You're going to have a far bigger consideration on your hands in terms of how nature is impacting you and how you're impacting nature. This is a piece of study which again helps to set the context that there is a large recognition that biodiversity is important in terms of our business strategy. But as you can see from the bottom chart, very few people are then taking it into consideration in their decision-making process. So we have this anomaly, and we better start looking at this quite carefully, would be my suggestion. Otherwise, we're not really recognizing the risk. Now, I think the last point that I wanted to bring up in terms of context is a fairly recent report by Bank Negara and the World Bank, which looks at the impact on the financial sector from nature-related financial risks. Now, Hitesh talked about the second bullet point, so I won't spend too much time on it. But there is a distinguishing factor that we need to appreciate. We are either dependent on natural assets and their ecosystem services that they provide, or we impact upon them. Now, Hitesh talked about the fact that 87% are impacted, but I think very, very significantly, you need to look at the fact that a lot of businesses, the lending at least, is highly or very highly dependent on ecosystem services. Now, this is the banking sector. The question should be in your minds, and in fact, in the minds of the capital market Malaysia, is then what of the capital market? Would this be similar? It's quite likely I think one of the few exceptions is that in the oil and gas industry, they don't tend to utilize much from the financial services as they do from the capital market, as in, they don't have as much lending from the banking system as they tap onto the capital market. So your risk from oil and gas is probably going to be higher than this report that you see from Bank Negara. And since we're talking about a capital market, there was a piece of work that we did, and Tan Sri Wahid, who is not just an ACCA member, chairman of Bursa, board of trustees in WWF, made the comment, which we absolutely loved, which is just as how we have various checks and balances on the financial capital, on the financial side of it, we really need to start looking at the right checks and balances on the way we are impacting the natural capital. So enough of the context. Let me move into what we are seeing in terms of the whole space on financial reporting. Now, I want to be clear. When I'm talking today, I'm talking about the external reporting, the financial reporting of nature-related risks. That's because in the first event, which was with Capital Coalitions, they were really talking about more internal reporting, how you sort of account for natural capital and make decisions on it. But today, it's really about how you're possibly going to have to report on this externally. So today, again, it's rather messy. As you can see, there are about more than 600 sustainability reporting requirements across the world. This, as you can imagine, is not a very tenable situation and needs to be fixed. It's costly, it's complex, it's difficult to benchmark, it limits transparency, and then you don't have a global consistency and comparability. And if you don't have that, then it really diminishes the trust in the financial markets. So then what's happening, right? So one of the things, couple of things I want to talk about today. One is TNFD, to expand on something that Hitesh was talking about. And then I will move on and talk about the ISSB. So for those of you who are familiar with TCFD, which is the Task Force for Climate-Related Financial Disclosures, then you might perhaps breathe a little sigh of relief, because the Task Force for Nature-Related Financial Disclosures, or TNFD, has borrowed quite a bit from TCFD. And you can see from this framework, it looks very similar to TCFD, except where it says climate-related, it's been changed to nature-related. And one of the sort of key design considerations that TNFD is talking about is to have a consistency with the global emerging baseline. And that's why they're looking to maximize the kind of consistency and language with TCFD. And that helps organizations and prepare us to know that it is basically a similar sort of approach, but now our lens is going from climate to nature. The second sort of key design considerations, which won't be surprising to you, but it's still important, is that these disclosures will need to be integrated into your mainstream financial reports. Again, if you're already doing something along the lines of TCFD, then you'll be familiar with it. I'll just make a short pause and highlight that for those of you who may not be aware, Bursa Malaysia just, I think, gone through a consultation process where they're trying to look at bringing the TCFD recommendations into the listing requirements domain. What exactly are those details? I probably have to leave someone from Bursa to talk to you all, since it's still at a consultation phase. Now, one of the things, whenever you see a framework like this, I think it's very important to ask who's behind it, because that's going to tell you how fast this could move, how wide the impact could be. And I've put a link in here because the G7 has basically thrown their weight behind TNFD. And if TCFD is any example, you would see a mirror impact in terms of how TNFD is going to be rolled out. So what I'm presenting to you today on TNFD is from its beta release, which is effectively not even out as a standard, but it is putting it out there so that the public and businesses can engage with them, can give them some inputs in terms of how this is going to be impacting them. And that's why they're doing consultation groups. Now, Again, I'm just going to pause here and say, if you notice, there are a couple of regions which are missing: Asia Pacific and the Americas. And these are two important regions which I feel are too big to ignore. Definitely, even if you talk about nature, but just talk about climate, it is too big to ignore. So this is hopefully something that TNFD will start to take into account. I know yesterday they made an announcement that one of their knowledge partners that they've just added on is the National University of Singapore. Apart from that, there are not that many from Asia except for Japan. So this is something that I feel, and I'll touch upon that a bit later, about how we need to elevate our voice. Now, a little bit more, and again, you will find that TNFD has spent a bit of time to help people work through how they're going to look at this impact. And the realms here are, how we start off, which is, you look at this whole space in terms of where are your assets. Are they, from the realms of land, ocean, fresh water, or the atmosphere? And the biomes are really the sorts of vegetation that you will find coming out of these realms. And if you look at the color coordination, it helps you to get a feel for where these biomes are sort of coming from, where there is a mix of land and ocean. It's separately marked out with that green and blue. Where there's a bit of fresh water, then you see that three stripes going on. So it just helps you to kind of get a feel as to which biome are you interacting with. And then you look at the environmental assets as well, which then give rise to, on paper here, it's about 25 ecosystem services. But as you know, this is just an example, and there could be more than just these 25 ecosystem services. And we'll talk about that perhaps, and maybe even in the Q&A session around how would you look at this? How would you start using these sorts of frameworks? The other thing that I would just mention very quickly is one of the fundamental principles in TNFD, and I would say this distinguishes it from some of the other frameworks, is its emphasis on location. So it basically starts with where your location is. However, as quickly as I say that, I want you all to understand that here, it is not just about your direct operations, but also, if you go upstream and downstream, which if you were looking at the climate side, they talked about scope 1, scope 2, scope 3. In the TNFD language, they're using terms like upstream and downstream, which essentially is about the same thing because it's about the entire value chain. So you start with your location because any impact that nature is going to have on you, you call it your dependency, or your impact on nature is bound to be more location based, and then you start to evaluate and assess it. And when you evaluate and assess it, then you come across issues of materiality, which Hitesh kind of touched on, so I won't spend too much time on it, but the point remains that when you look at materiality, you look at it in terms of how you are depending on nature and how you are impacting nature. As you start to prepare these kinds of reporting, scope is really important because, as you can imagine, your value chain is huge. So TNFD recognizes it, and it's also said that it's prudent to start with a narrow scope and then expand over time. But there's always a however, and the however is that you have to make a statement on your plans for further disclosures in the future. For financial institutions, your scoping choices may involve the types of asset classes that you're going to cover, the types of lines of business. In fact, there's in the TNFD document, the beta release, they have a separate leap approach for FIs. So I'd recommend that you have a look at it to see how this could potentially impact you. Now, the question that would be on some of your minds would be, okay, all of this is great. When is this going to happen? Well, firstly, I think this beta release is going to go through several iterations, at least 4, and they're probably looking to launch this in September 2023. So it sounds like you have a bit of time, but honestly, let's maybe talk about that, later or in the Q&A, right? Now, the other thing that you might be thinking about is, well, all of this is, new, but we've also heard something new, which is the ISSB, the International Sustainability Standards Board. So let's talk a bit about that. The ISSB was set up, I think, after COP26. And this is where I think a lot of the bigger countries in the world decided to put their backing behind ISSB. And at the first step, it's a consolidation between the CDSB and the Value Reporting Foundation. And the Value Reporting Foundation was itself a combination of the IRRC and SASB, which is American. So this is a coming together of several bodies. Why? Because they recognize how the whole reporting on climate, on environment has gotten so complex, and they needed to do better by organizations and by governments. So this is where they've started to do this. And they have proposed what they call a buildings block approach. So for those of you who are a bit more familiar with the financial reporting today, this is very much where you have the IFRSs, which is your bottom left box. Building on this financial reporting, which impacts your assets and your liabilities, and your income and your expenses, then you have the work that ISSB is doing, which is sustainability related financial disclosures. And I want to emphasize the word disclosures, because disclosures means that it doesn't mean you have to book this into your asset or your liability, into your income and expenses. But disclosure affects transparency, and it affects the level of trust, not least by the investors, but by several other stakeholders today. Then if you leave the remit of financial disclosures and you go into the broader sustainability reporting, then you have the works, for example, of GRI. Now, let me present this in a different way, if it helps, which is, if you just talk about the International Accounting Standards Board, they are just concerned about what's the ways in which you account for things and book them into your financial statements. The ISSB, as I said, is looking at disclosure standards, and they've just put out 2 disclosure standards for comments by the public again. The S1 is the general requirements, and the S2 is on climate related disclosures. I've put links in this, and I think when these decks are shared with you, you can automatically have a look at these things. And then I've also put a link, because we won't have time to cover this today, but it'll be good for you. If you're not from finance, you can use this to have conversations with your finance teams. If you are from finance, you can use this to have conversations with your business unit heads about how, even on the climate related matters, how these effects will affect your financial statements, whether they are in terms of taxes or whether they are in terms of the fair value of assets, stocks, value, etc., etc. Then I just wanted to spend a little bit time on where will this go forward, because you will be right in saying that the ISSB will just focus on the financial side, and then what about GRI? They are not part of the whole merged group. So this is where they're trying to get together. They've signed an MOU on the 24th of March, which would, as a first step, involve both sides sitting on each other's bodies to provide the kind of direction. But on the future work plans, I think they're looking to create consistency around terminologies and standards and metrics, which is really important, because otherwise you as preparers are going to have a pretty difficult time, really, in terms of preparing your financial reporting. Last slide, and then I'll stop, is effectively, you need to start preparing now, because going back to one of my earlier slides, if your dependency on nature is something that you're not clear about, you need to start getting clear about. If your impact on nature is something that you're beginning to start to work on, you need to, because getting the data from some of the organizations and the CFOs that I've talked to, getting the data is not a 6 months exercise. It's much longer than that. Then you need to get the thinking right. You need to get the systems and your people all bought in. All of this is going to take time. My last point is about the fact that if I go back to how TNFD is doing consultations, and our voice in Asia is not very strong in there at the moment, there's 2 parts to it. One is on that side as a standard setter, but it's also the fact that, and I say this from my position in ACCA, that very often it's difficult to get Asian businesses to want to play this type of role, to either on an industry basis or any other form, to influence the direction of policy setting. And I think this is important because all of you will probably largely agree that Asia is the region of growth, perhaps in this century. And if we are, then the kinds of rules and standards by which we are going to play, we have to have a voice in it. We need to have the right voice in it. I'm not saying we should shirk our responsibilities, but we need to have a voice in it. So I'll stop here and I'll pass this back to Zara.
Thanks very much, Sharat. So we now start our Q&A session, and I will now introduce you to Luann Seah, who will be the moderator. Luann is the head of Group Sustainability at CIMB, one of ASEAN's leading banking groups, where she is responsible for transforming CIMB into a shaper of sustainable finance and responsible banking practices in Asia. She has extensive experience in sustainability, strategy, and transformation, as well as change management. Luann has been involved in a number of fields, including financial services and consulting. She's also a founding member of a startup company. Luann holds a Bachelor of Arts and a master's degree in manufacturing engineering, as well as a Master of Arts from the University of Cambridge, and has recently completed a Master of Liberal Arts and Sustainability at the University of Harvard Extension School. Okay, over to you, Luann.
Thank you so much, Zara, and thanks to both Shara and Hitesh. Do we have the other speaker? Hitesh, you there? Okay. All right, no worries. And thank you, David T, for your questions. I will come to them. I like your questions very much. And please, for the rest of the audience, please do send in your questions, and the more difficult, the better, because we've got very good speakers and panelists here for you today. Right, so I do want to start off with a very basic question, which is, you've talked about externalities and valuing that, right? And this is actually David's question. So how do you actually capture the data on externalities, and how do you ensure that the data is real and it's real, well, assured data? I guess the question is to Sharath, because I don't know where Hitesh is.
Absolutely. I'm jumping to take it. But look, I think it's a very important question by David. And as I said, I think do not underestimate the process that it takes to get data. Let's try and break this down maybe into something that we can relate to. Let's say, I don't know, let's say I talk about my previous life in the palm oil sector. And if you're in the palm oil sector, you might have some plantations along the coast, which are in turn going to be impacted by various elements and risks, right? And that results in perhaps saline water entering in. Now, for you, firstly, your step is you got to know how many of your plantations are in the coastal area, which I would like to assume people will have that data. But then you're going to have to work beyond that and say, okay, of these which are at risk. And you will be surprised, because the meteorological department does have data. It's just that people may not be thinking immediately of going out into public sector agencies to get this data. So my advice to people is, look, actually go out and talk to them, because they do have a lot of data. From there, you will take a little bit of modeling to figure out how is this impacting going to change over these next 12, 20, 30 years, your assets. As you do that, then you might find, and again, I know from the palm oil sector that they could forecast changes in oil yields just by looking at these patterns. So it's really fundamental that you start with, understanding where your dependencies are and focusing on that, and then you go and look for the data around it. But the point I'm trying to make is, if you think the data is just residing in your organization, it is not going to work. That data will, I think, be largely also coming from outside of your organization. And then you start to, as I said, looking at this and valuing this is not a one-year picture. In my opinion, possibly not even a 5-year picture. You need to be looking at, how long are these assets lasting? In the palm oil sector, you're talking about an average age of 25 years, which means you have to start using that as your life cycle. So I'll stop there, also because Hitesh has joined us, and I'm not sure if he wants to talk about from the true value perspective, but that's my perspective, having gone through this and seen how we calculate it.
Great. So thank you, Shara. So you've talked about kind of impacts of external factors such as salination, for example, on businesses. Now let's talk about the impact of businesses on the environment. Environment. We're not talking about people today, but on the environment. So this question would go to Hitesh. So how do you assign a dollar value to the impacts that you're creating on other people and the environment? How do you assign a dollar value to that? Because you've got nice charts with pluses and minuses, and there's this dollar value. How does that come about?
Sure. Thank you for asking that question. Yes, I think that's where the actual, the brain power has to be put. How to really assign value, right? Unless and until we put financial numbers to it, the conversations won't really hit the right people, and nobody will really appreciate what are we trying to do. And one way is to look at to the extent what kind of a negative impact it will create. So let's talk about greenhouse gas emissions, right? If for any organization, the emissions or the air pollution where the facility is, right? If the air pollution is changing, there are a lot more pollutants in the air. It means there is a negative impact on the people residing near that plant, right? So you look at the health data, you look at how people are getting impacted, what kind of diseases people are getting in that vicinity, and what is the cost of human life. And that's how I think we should start talking about the cost of, polluting the environment, because it's impacting the people, it's impacting the biodiversity, it's impacting the water which is coming to your plant, it's impacting the air which is, people are breathing around your facility. So that's one easiest way to, start looking at the impacts. You compare it with the human health cost.
Okay, so it is actually really complicated. You need to understand what impacts you're creating, and then you need to understand the knock-on effects on humans, and then quantify that. Wow. Okay, so that sounds really, really laborious, and I think if we
laborious as well as sorry, I'm just adding to that. So it is laborious, and at the same time, a lot of these externalities, the cost of externalities depend on the databases. This information is not available with everybody, right? So we have to look deeper into the databases, understand, access, the cost which is associated for human health or for biodiversity loss. And yes, many organizations they are doing it. Many cities are in fact have started to look at the cost of negative externalities. If cyclone is going to hit them, or if flooding is going to hit them, they are able to estimate the cost it is going to incur, or what kind of a GDP impact is going to make in the next 5 years. So yes, this includes a lot of database and research for us to calculate these numbers.
So it does sound like that if you do take into account all the externalities, especially the bad stuff that you're causing downstream, the cost of business, the real cost to your business is actually much higher than what is in your current P&L. Does that mean then your costs and your product costs is going to go up? And if so, who's going to want to do it? What are the first mover advantages of doing this? Why can't we just wait until everyone does it, or the government says, okay, you have to do it?
Yes, I think that's again very important question which you have pointed out. So who's going to take the first step, right? If you start internalizing it, many businesses will go bankrupt. I remember the first time when we had done this in Mahindra a couple of years ago, and we showed the environmental profit and loss statement to the CEO. And he said that, you're giving me a heart attack because you are telling me that today, rather than if I look at my accounts, I'm making $20 million profits. But you are telling me if I have to internalize my externalities and the cost of damage which I've brought to environment, I am in a 500 crore loss, right? So yeah, it's a very complicated thing. But at the same time, we have to start paying premium. We were talking about palm oil. And in palm oil, in fact, we are doing one study where we are trying to understand what's the cost of premium, right? So if you are consuming, let's say, peanut butter, right? And it includes palm oil in that. If it has to be a sustainable certified palm oil, it will increase the cost. The premium attached to that will only be in few percentages, right? So I think to that level of extent, we will have to look at what is the premium. Sometimes it looks scary that we will have to put a lot of money. But it's not actually the case. So I think that's where I'll stop.
So can I just jump in, Luan? I think, I don't want the audience to go away thinking that this is all about a reporting problem. It is not. It is fundamentally a business problem, because if you impact nature, it is bound to come back and impact you, which is your dependency, right? And Bangalore has already done the studies, and either the impact or the dependencies are high, right? So if you're not watching the space, that's my concern. If you're not watching the space, then we're not really thinking about the risks that could affect our business value. The financial reporting, as I think Azlan has raised a question or a comment, it's going to have its limitations. But this should not be an exercise about the tail wagging the dog. Pardon my French if that's not the best expression, but yeah.
Yeah. So, see, this reminds me very much of the conversation in the 60s when the oil companies actually knew or had some kind of inkling that they were causing climate change, but because nobody else is talking about it, because it would mean an increased cost or a reduction in business, it was let's not do anything until we have to. And here we are in 2022, and we're still trying to fight the same battle. So 50 years, right? But anyway, now one of the key levers that have started to move the climate equation is really carbon price, right? It's the polluter pays principle, and this comes to the question of anonymous attendee, no name. How could monetizing the value of ecosystem services help this? So is there an equivalent kind of pricing mechanism? Because that's the language of business, right? Is there an equivalent mechanism for biodiversity, and how would that work actually?
Hitesh, you want to take that or shall I?
No, go ahead if you have any.
Yeah, look, I think this is something that's been bothering me, Luan, because firstly, when we talk about a carbon price, today there is no global standard, not as in one that is accepted the world over, right? Some jurisdictions, and I think even in Singapore down south from us, they're proposing a carbon tax. So rather they have a carbon tax and it will kick in time. Some organizations are not waiting for that and calculating their own internal carbon price. Okay, so and that therefore means organization A to B to C is not having a comparable carbon price. That's carbon. Now let's talk about water. Okay, because that's, I don't know why, I just have a gut feel that that's going to be our next major issue. But never mind. Just talk about water, and we do not have a comparable measure. There's no water price. As far as I know, as an accountant, there is no water price anyone is throwing out there. So this is a challenge for not just the profession, but the community to kind of figure out, now, how are we going to do this? Like I said, there are some proxies along the way in terms of, as an organization, you can already determine the impact. The other thing that we haven't really mentioned, which I should now, is this kind of work involves a lot of science. And therefore, I don't know who our audience is, but if I'm assuming some of them, or many of them are finance folks, look, you can't do this on your own. You've got to have some pretty good people that you're working with, not necessarily in your organization, but externally, who will help to shed the light on the science. And then you start to work out some proxies. Second, and I'll stop after this, which is why I raised the point about working as industry blocks. Because you can't, I think, my personal view, you can't take company ABC and try and change the whole world. You saw what happened to Danone. They tried it, and the financial markets rebuked the CEO and he lost his job. So I think there's a level in which you need to work as a pack. I'll stop there.
Yeah.
Yeah,
and,
I think just to
yeah.
add to that, and we raised a very important point, about water tax. I mean, so carbon tax, yes, has been there for quite some time, and companies are internalizing it. But not every company, is still able to use it in the business sense. They have it because, let's say, it's a CDP requirement, or it is somebody else is doing it. Hence, we should also, have a internal carbon price. But the actual test of these taxes is that how you are using it to reduce your emissions. What's the end goal of it, right? If you don't have those targets in place, then there is no meaning of water tax or a carbon tax. Why do you even need a water tax? So that your dependency on fresh water goes down, and you are able to, let's say, recycle more water, right? You are able to harness more water. For carbon tax, what is the need? So that you are able to, let's say, reach net zero using a tax. Right. So why we are doing these valuations also for an organization, we have to have an objective. It cannot be just because everybody is doing it for, let's say, I should also, estimate my externalities. Estimating externalities, corrective actions, yes, it's the right step to do. I understand that my impact to environment is very high, and hence I need to first measure what is my impact, so that I can start taking corrective actions, is the right thought process and frame of mind. Just wanted to add to that.
Thank you. Okay, so I think we're going to extend for a couple more minutes. Yeah, but thank you for all the good questions. So we talked about, including externalities into, company valuation, etc., setting targets. The question, I guess, and I see a lot of, I looked at the attendees list and I see a lot of IR people attending investor relations. Question is, okay, you've got all your investors saying, oh, I want you to do this, I want you to do that. But actually, are they willing to accept that it's an investment, and that means, and I saw on your slide, Hitesh, profit maximization? Can that still work? Profit maximization, what investors want, and still they're saying, okay, make sure you be carbon neutral, make sure you don't have a negative footprint. How does that all jive together?
Okay, I'll just give one example for that, and I think that will answer. When in Mahindra, because I've spent a lot of time in Mahindra, these examples keep coming to me. Between the period 2016 and 2019, Mahindra Group, for the automotive and farm business, they invested $4 million to $5 million every year on projects which are related to energy efficiency. Okay, the payback of these projects was within 15 months, right? And the company has, reduced its cost of operations. The company has been able to meet 25% GHG reduction targets. And what it has done is increase the competitiveness of the products per product which the company is making. So if a company, and that's why I think it's an important example that which Sharath also mentioned, that sometimes these investments pays back in a bigger way. Right? When you're trying to do good for the environment, it reduces your cost of operation. The moment it reduces the cost of operation, we are talking about cash flow. We are talking about increase of profit. what else investors need. Doing good, making money. I think that's the best thing one can have.
Can I provide an alternative view? Maybe speaking as an accountant of, I don't know, more than 25 years, and there are, to my mind, maybe two ways here. One is like a speedboat where you can make these turns very sharply, and the other one is like a cruise liner where it takes miles before you can even make a turn. So, Nguyen, I don't think some of these changes can happen without investors recognizing and appreciating that they've got to accept a lower payback for a period of time. The question they need to be asking is whether they're going to accept that now, accept the pain, because otherwise that impact is going to be far bigger in the future. Or to your point about the oil and gas, let's not talk about it. Let's not do it now. Let me retire and leave this organization so that I don't have to answer to my shareholders about why these returns are dropping. I think this is the real issue that is going on from some of the conversations I'm having. It's not keeping track. The other thing I would say, and I think this is one of Hitesh's earlier slides about the whole financing gap. And I make this sound flippant. Maybe I'm intentionally being contentious. That gap is only in the billions. It's only in the billions. In the global financial crisis, we spent trillions. We spent trillions keeping the financial system afloat. So I'm not convinced when anyone says that, this is all going to cost a lot of money. The fact is, there are other reasons why this is not happening, and that's what we need to address. Better pause here before I say anything that might cause me to lose my job, but yeah.
Okay, so I'm gonna end off with an easy one, and this is to both of you. So I think what I hear is, okay, this is important, it's gonna impact you, so start now. So the last question to both of you is, okay, so start now, but what can I do today? What should I start with? Maybe first 2-3 things for the businesses out there.
Go ahead, Sharad.
Look, I think the first thing that you need to start doing is to figure out, don't look at the numbers first, but look at your value chain and see where are you impacted. And again, let's just take it one level down because I can't go both ways. If you're looking at your materials, where are you getting your materials from? And if you look at that supplier, where is that supplier getting it from? All the way till you trace it back to nature. And once you hit the point of nature, look at the locations where it's coming from. And then you got to start asking, as a businessman, am I at risk of that supply getting into a disrupted mode? Because today we're already seeing it, right? I mean, something small happens and, we don't have enough chickens going to Singapore, for example, right? Something bigger happens and we don't have enough wheat to go around. So it is not just nature and biodiversity that is going to be a problem. As we can see, there are many other things that happen in the whole ecosystem, wars and fissures and all that kind of stuff. All of them, if you're a businessman, your fundamental responsibility is to figure out how is your value chain going to be impacted. If you can get there, then I think it's around putting the data to it. But the first step, I think, is think like a businessman and you want to ask yourself, how do I make sure that I manage the risk around this? And then you can get Hitesh to come and help you with some modeling on your data. Hitesh, I just plugged you in.
Nice segue.
Thank you. In fact, I'll take your last point as my first point, managing risk. I think this is what businesses do best, right? And they have capabilities to understand the risk and then put strategy to manage it and mitigate it. I think climate change, sustainability, ESG, or natural capital valuation, what are we talking about? We are trying to use these techniques to manage our risks, which are, of course, not maybe, let's say, financial risks, but physical risks, transition risks, reputation risks, right? So these are the risks which we are trying to manage using these tools. And I think why we should do it and what are the immediate steps is like, let's say, all the businesses, we have to be competitive, A, in domestic and B, in international markets. When we take these initiatives, when we manage the risk better, we become more competitive. I think that's the language we have to talk about, right? Rather than trying to become activists that, yes, I will, solve the global problems by making sure that I have a good PR person who's doing environment. No, I think it's about business. What language me and Sharad are talking about is for the benefit of the business. And for us to become more competitive, because now you see the CBAM, the Carbon Border Adjustment Mechanism, which has come from Europe, right? It is going to shift the balance of international trade. It is not going to be easy for companies to be competitive at the global landscape. So it is very important that we start managing these risks better. We reduce the carbon life cycle emissions of our product. We take commitments and targets, right, which are long term, not just short term. And then when we do this, we will be able to, we will be in a better position to estimate and internalize these externalities. And then, of course, have a mitigation strategy for that. I'll stop there.
Sorry, Luan, can I just come in very quickly and say that what surprises me, again, as an accountant and looking at this for the last few years, I don't see enough business people, public listed companies, if I may be so bold, tapping on the tremendous opportunities that are there. I don't see enough of that. So much of our conversation today is about risk, and it's very valid. But look, behind every risk is an opportunity and green technologies and all kinds of things. But I don't see that as much as I would like to. And I don't know whether that's a call out to our community out there today to say, why aren't they?
That is a very good observation and question, and is the topic for another webinar because we are 12 minutes over time. All right, so thank you, everyone. Thank you, Sharath and Hitesh, for being such good sports, answering all the questions. Thank you for Saratha, David, and everyone else who asked the questions. And yeah, it's starting to rain and internet's getting bad, so time to go. Back to you, Zara.
Thank you so much, Luan, Hitesh, and Sharad for those great insights. So prepare now, get involved, identify and manage your risks, and find your opportunities. Unfortunately, we conclude our session for today. On behalf of CMM and WWF Malaysia, a sincere thank you to our speakers, our moderator, and you, our very engaged participants, for joining us today. For more on natural capital, do have a look at our last session and keep your ear out for our future sessions on natural capital throughout 2022. Have a good rest of your day.
Thank you so much.
Thank you. Bye-bye.